with me here today as we embark on another panel about REIT equity offerings, IPOs, and blind pools. To take a phrase from Deborah Cafaro, I think we may also talk about the banker-induced IPO pipeline. I am going to kick it off nonetheless to Mike Kirby. Mike, Green Street has been very outspoken. You've been outspoken that REITs need to delever. You have a very strong thesis and view on this, which is hard to quibble with. In March of 2009, you published a report that indicated that REITs needed to raise about $100 billion to appropriately delever. However, by my count, only about $22 billion has been raised since then. Do you feel there is a $78 billion disconnect and delevering need still? And if so, why haven't the REITs raised that money?
This is an industry that, for the life of most of the participants in it, has had a culture of debt. By necessity, debt financing has been the primary source of capital for the real estate industry since the beginning of time. And 20 years ago, the industry met the capital markets. And these companies have yet to fully adopt the culture of the capital markets. And what I mean by that is corporate America operates itself at a 20% leverage ratio. Some of the best companies in the country have virtually no debt. They see no need to. A company like Microsoft that has a steady stream of, very predictable stream of income has next to no debt. They don't ask the question, how much debt can I get? They ask the question, how much should I have? And real estate people seldom ask that question often enough. And so it's an industry where if you look back on 15 years of performance, the more levered companies have not outperformed the less levered companies, which is stunning because they should have. If you take on more debt, you should offer higher returns. And there's just no good reason to push the limits. You can certainly have some debt, it doesn't hurt, but there's just no reason to push any type of a boundary that might get you into trouble. And so just to put it into perspective from a debt to EBIT standard, the industry operated fairly prudently in the 90s because it had to come very clean when it came public in the 90s. Through most of the 90s, the debt to EBITDA multiple was about 5. At the very peak of the mess, it got to 8, which clearly we now know to have been way too high. Despite all the equity raising, we're now down to 7, which is still, in my opinion, far, far too high. So, yeah, I think we've got more to go. I think there's a lot of lip service being given to it by the companies. I think most of them have the intention to slowly delever, but we'll just have to see if the culture will change.
Mike, do you have any thoughts?
I generally agree with everything my friend Mr. Kirby just said. I think I can answer a little bit of the why, and that's that we've just gone through a massive, obviously, correction not only in the real estate space, but across the global economy and the global capital markets, and raising equity is extraordinarily expensive. And so you have the strong companies that did it and actually led the industry's way towards towards re-equitization. And they did it in a really defensive way because while their balance sheets were better than most, they were still on that list at the absolute pit of all this that everybody was on, which is who goes bankrupt first in the real estate space. And everybody was on a list, some were just at the back of it and some were at the front of it. And now that they've done raising that money on a defensive basis, I think you'll see those companies raise more money on an offensive basis as they try and take advantage of growth opportunities. On the other side of the coin, you have some of the more levered companies which have done some really expensive deals. And there's only so many times you can sell half of your company, in a shot to raise a couple $100 million. It's not something you want to do every Thursday. So what those companies are going to do is they're going to, try and do a step function. I do think that, as I said, Mike is right. There should be more delevering, and I do think you will see more delevering. I just think it's going to be a step function for both the stronger and the weaker companies, where they try to now, in a step function way, raise the equity at more attractive levels over time. So it hasn't been, nor do I think it should have been, a situation where every company just goes and raises all the equity they need to get their balance sheet exactly where they want it forevermore. People have been raising, understandably, enough to get themselves into a safe zone and then try to raise more later. And it's just a function, of economics.
So, Murray, there seems to be a consensus that more equity should be raised. But the REITs, the REITs, I think Mike Kirby referenced that REITs seem to have been giving some lip service, or at least are apprehensive about raising equity. Are they being too optimistic in terms of availability down the road and improved pricing of capital down the road? It does feel like REITs are, from a valuation standpoint, are trading at pretty good values today. There seems to be a lot of focus on cost of equity and how dilutive it is to earnings. So there's a lot of anxiety out there. What are your thoughts?
Yeah, I think it's a couple of things. One is a combination of, the balance sheet repair trade of 2009 was quite painful, and I think mentally and emotionally scarred many of these issuers. So a little reticent to come back, too quickly. I think, Mike's comment that the space is trading at 7 times debt to EBITDA. I don't know if 6 is the right number, 5 is the right number, but regardless, it's $50, $60 billion of equity at some point. I think the use of proceeds to get these issuers to actually come to market this next go-round is critical. And I think the good news is that the market has voted that these are the vehicles of choice for consolidation. I think if you've seen what's happened last year in the way of issuance. So the good news is the market's backing these guys. There's no lack of availability of that capital. We've been out in the market the last couple of weeks on deals, and it's impressive how much capital is there to back these companies. I think from the issuer perspective. The use of proceeds is something that, I think they have to have a clear vision and more transparency as to when they can put that money to work. But having said all that, from a pricing perspective, at 19, 20 times AFFO multiple, and frankly, the property fundamentals, I think we'd all agree, are far from being out of the woods yet. Leads you to believe that the pricing is pretty attractive from an issuer's perspective. I think David Simon even mentioned that in his comments this morning. So from our vantage point, the capital is absolutely available. Pricing is possibly as good as it's going to get for a while. Unfortunately, I think these companies are reticent because they don't have that clear use of proceeds yet. From my vantage point, I'd rather have the cheapest cost of capital on board that today, so that I have the capacity to take advantage of those opportunities when they come, because we all think they will come. They're just not here in any large size to today. So the bottom line is I think they will issue. It's just a matter of time. And frankly, I think the smart ones are out issuing now and creating that capacity, because ultimately to grow, if they're starting out at 7 or 8 times EBITDA, there's not a lot of room to take on that next acquisition. And I think the last comment I'd make is I think Ed Walters or one of the guys this morning mentioned the comment that transactions today, you have to show up with a signed contract, with capital, be able to move quickly to take advantage. That's absolutely right. Again, contrary to kind of everything we're living through right now. But that leads you to further evidence that if you're one of these public companies, I would rather be in a position of strength like a Simon, who's got big cash on the balance sheet and the ability to do things. That's a better place to be, and bottom line is the companies, in my opinion, should be out issuing.
Matt or Richard, you guys are arguably less biased than say Murray or Mike, who do have capital raising arms. Question I had for you guys then is if a REIT, and this is a generalization admittedly, but if XYZ REIT comes to you and says, I clearly need to get my leverage down, should I do it now, given where my stock price is at 18 to 20 times AFFO, or should I wait, i.e. is my stock price going to be higher in 12, 18 months from now to raise equity, or the market's going to be more attractive at that point in time, or would you encourage them to do something sooner versus later?
Look, I think it goes back to Mike Graziano was talking about before. I think it's a little bit the step function. When you say sooner rather than later, I mean, it depends on the situation of the specific company, where they stand right now in the capital structure. But I do think I do want to take the question in a little bit of a different direction also, because one of the issues that comes up about raising capital is kind of how it's raised, and I do want to actually You mentioned what Debbie Cafaro said earlier about the banker-induced pipeline. I actually wasn't in the room for it, but I did want to comment on that, which is one of the things that's out there a lot today is the issue of how it's raised the existing companies. We haven't really gotten to the issue of the blind pools yet. And I just wanted to make a couple observations on that about if someone's going to put money to use today, how, as an investor, how I think you actually should put it to use. And as you said, Matt and I, we're not underwriters, and it gives us the opportunity to be maybe a little more pure about it, which is that one of the things you're seeing today is the fight over who gets the capital, and should somebody get, blind pool, should you get the capital to take advantage of what's going on in the market?
But I would say, again, we're somewhat agnostic on the sort of public equity raise, and what the other thing we pay a lot of attention to is not just how much leverage you have, but obviously the structure of the leverage. And a tremendous amount of focus has taken place on what the right-hand side of the balance sheet looks like. And so that can take the form of, what's an appropriate structure, not just the amount, what's secured versus unsecured, how do you unencumber assets for financial flexibility in addition to issuing leverage, a fair amount of looking at how do you convert existing securities into something more friendly by pushing out maturities or putting it into a form that's more likely to equitize than what's currently there. And so the push to equitize takes a lot of different forms, and it's one of the reasons I think it'll take a long period of time. I think issuing equity in one shot to delever is unlikely to happen in most cases, but the two places I'd say a lot of companies are looking at as an additional tool or vehicle to delever is a sort of optimize the capital structure on the right-hand side of the balance sheet so that to the extent you're dealing with more leverage than financial flexibility, than the sort of financial flexibility you prefer to have, you can push it out and have it in a way that still leaves you with more flexibility than perhaps some of the balance sheets got to when they were caught in the post-Lehman sort of market conditions. The other thing I'd say is, and it ties in with some of the discussions around the asset markets, is there's a great deal of capital available on the asset side of the balance sheet, either for joint ventures or for asset sales. And I think one of the means of right-sizing companies' balance sheets and getting to a more optimized capital structure is also to look at the left-hand side of the balance sheet and use assets and or joint ventures and or sales to optimize what the balance sheet looks like beyond the issuance directly of public equity.